Corporate Finance Excel practice problem. In this presentation, we will work a practice problem in Excel related to increase in retained earnings, calculating the increase in retained earnings, and calculating earnings per share. Get ready, because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, where we will calculate the increase in retained earnings and then calculate the earnings per share. Note, as we calculate the increase in retained earnings, we're not talking about the statement of retained earnings here, where we will typically start with the beginning retained earnings, then calculate the change to get to the ending retained earnings that will then be seen on the balance sheet. We'll talk more about that statement in a future presentation. Instead, we're going to be calculating just to get to the increase in the retained earnings, because that's what we're going to be using then to calculate the earnings per share. This is something that you may see on the bottom of basically the income statement. Note that the retained earnings can be one of the more confusing types of accounts because it deals with basically the income statement. So when we think about the balance sheet, retained earnings is part of equity. Assets minus liabilities equals equity, meaning it's part of the owner's claim to the assets of the company, as opposed to third-party claims, which would be the liability claims. The retained earnings represent the earnings that have not been distributed in terms of dividends yet, as opposed to the common stock and additional paid-in capitals, which represent the initial investment of the owners. Now, the retained earnings then is going to change with regards to how much the earnings have taken place. That means that the income statement, which represents a time frame, has a beginning and an end, such as January through December for a year's time frame, will then roll into the ending balance of the balance sheet. So the income statement, in other words, is us kind of taking out a piece, taking out a chunk of retained earnings. In essence, you can kind of think of it. It's part of retained earnings. It's the timing of retained earnings, whereas the retained earnings on the balance sheet is the ending balance in retained earnings, what would be there at the end of the day after we close out the income accounts to it. We'll talk more about that later as we keep constructing these balance sheet accounts, but let's think about the increase in retained earnings then as we go. So we're gonna have the operating profit. We're gonna start with the operating profit, which is part of the income statement. So we'll pick up the operating profit. So we're not starting with revenue and then cost of goods sold. We're kind of starting in the middle of the income statement at operating profit. Then we have the interest expense, which we'll take out of the operating profit. So we'll decrease the interest expense to get down to the bottom line on the income statement, which would basically be income or earnings after taxes. Let's subtract these two out. This is going to be equal to the 210 minus the 14,000. That gives us the 196. I'm going to put an underline under the 14,000 by going to the Home tab, Font Group, and Underline. This is going to be the earning before taxes. Then we'll add the taxes. So we'll pick up the taxes here, which we're going to be given as the 61,000. That's always the last thing basically on the income statement. So we're basically calculating the end of the income statement. Let's underline that 61,000, go into the Home tab, Font, and Underline. Then we're going to have the earnings after taxes. So the earnings after taxes will then be equal to the 196 minus the 61,000 or the 135,000. Okay, so now we're at basically net income, the bottom of the income statement. So now we want to get to the number that we can use to basically calculate the earnings per share. To get there, we're going to be pulling out the preferred dividends. Not all companies will have preferred dividends. They will all have common stockholders, maybe not all having preferred stockholders. The preferred stockholders are not preferred in that they're not really the owners of the company, as the common stockholders are, because they don't typically have voting rights, but they do have a preference to get paid first. With regards to the dividends, that's what the preferred typically refers to. So then we're going to say that's going to be the 18.7. That means if we have to pay them first, we got to take out the preferred stock portion before we get to the amount that could be distributed of the net earnings to the actual owners, those we think of actual owners, the common stockholders, which we will break out per share, per stock. So the 18.7, I'm going to go to the Home tab, Font, underline that. And then we're going to get to the earnings available now for the common stockholders, which is what we're really looking for, because we're typically, thinking of gearing this out towards the common stockholders, right? So this is going to be then equal to the 135 minus the 18.7. And so that's what's going to be available to the common stockholders. Then we're going to think about how much the dividends that went out to the common stockholders. So let's pick up the dividends that went out to the common stockholders. And that was the common dividends, we're saying. That's the 26,000, and that's going to give us our increase in the retained earnings. So that's going to be our increase in the retained earnings, which is going to be equal to the 116 divided by the 26. I'm sorry, not divided. Equals the 116.3 minus the 26. All right. Then we're going to underline the 26, home tab, font, underline. We'll put a double underline under the 90,300, home tab, font, drop down, double underline. So there we have it. And this is the increase in retained earnings. So remember, the retained earnings, the other way you're going to see this is in a statement of retained earnings, which really has a beginning balance and then the changes. The changes that took place, if you were going to think about this in a different kind of format, the change that took place in the retained earnings is basically the net income and then minus the dividends, right? Minus the dividends here, minus the dividends here. And that's going to be the earnings after taxes here, and then minus the dividends, minus the dividends. And that's going to give us, or not the sum, I could say equals this, minus this, minus this, minus that. That's basically our change, the change in retained earnings. All right, and now we can calculate our earnings per share, which we have the earnings. I'm going to go back up a step to the earnings available to the common stockholder. And we're going to say that that was the 116.3. We're going to divide that by the number of shares, the common shares, which we said was 20,000. So we'll divide that by the 20,000, and that'll give us our earnings per share. So we'll say earnings per share is going to be equal to the 116.3 divided by the 20,000. Usually I'd want to see decimals on this, so I'm going to add decimals now. Home tab, numbers, and we're going to increase the decimals. You could keep going, but typically we'll stop at 2 places, rounding it to $5.52. Remember that this cell actually has something other than 552. It actually has 552 and so on and so forth in it, right? But we're going to round it to the 552. Let's underline the 20,000, home tab, font group, drop down, underline, double underline the 550, the 582, home tab, font group, drop down, double underline. Okay, so now the normal calculation for the earnings per share then is the earnings available to common stockholders divided by the number of shares. So in other words, we had the earnings here, and you would say then, you would think then, okay, how much would you get for earnings per shareholder? Now notice, per share, notice if you think about the owners of the company, you're typically thinking of the people that have the common stock, because the common stock is the voting stock, which gives you the power to vote, and therefore those are the people that we typically think of as, you know, the owners in the company. Now, one person could own multiple different stocks, right? So we're not going to be breaking this out per person that owns the company, but rather per share, and then the owners, different people could own multiple different shares, but the shares will all be the same. So we're going to take the earnings after taxes, subtract out the dividends, the preferred dividends, because they get paid first, to give us now the earnings, the net income that are going to go to the actual owners of the common shareholders. Then then you would think about that and say, okay, well then, how much could go out based on simply the earnings? We take that 116,000 divided by 20 and say, well then every shareholder, and again, one person could own multiple shares. If it was all distributed out, all that could be distributed out for the earnings per share, each owner would get 582. Now, you might think that that should match or be equal to the dividends that actually went out, but that's not the case, right? Because the dividends that actually went out could be are generally going to be that or lower than that. It could be higher than that because they could actually have taken earnings from prior periods and given them out. But typically, the dividends are oftentimes going to be lower than the earnings per share, right? So we had the earnings per share of the 582, and the dividends were only 26,000, right? And the 26,000, if you took the 26,000 divided by the 20,000 shares and added some decimals there, it was only $1.30. So basically $1.30 actually went out, on earnings per share, whereas, for actual dividends per share, whereas the earnings, if they were to distribute all the earnings, it would be 582. So don't confuse then the earnings per share with how much people will actually get paid out to the owners. And you might think, well, then the owners got ripped off. That's not necessarily the case. Why? Because some companies are going to take that money and put it back into the business, and that will hopefully increase the value of the business. In other words, if the value of the business goes up, then the value of the shares go up, and you can sell the shares at a higher price. So there's two ways that the company can increase or provide the owners with a return. One, they can earn revenue and they can give it back to the company in the form of dividends, or two, they can retain that money in the company, which you would think in and of itself would increase the value of the company, therefore increasing the common stocks, which could then be sold at a higher price, and hopefully reinvesting it in such a way that is profitable and increasing the value of the shares in the future.